faithfully delivering value by interpreting great books from around the world. Hello, this is Sally's Book Talk. Today, I'll be interpreting the book Trading for a Living for you. When you hear trading, you might think of commerce or doing business. However, here we're specifically talking about buying and selling in financial markets, commonly known as stock trading, futures trading, forex trading, and so on. Do you have any bitter experiences with stock trading that you'd like to share? Feel free to leave a comment in the comment section. Many people hope to achieve financial freedom through stock trading. In March 2022, the number of A-share investors officially exceeded 200 million, meaning 1 out of every 7 Chinese is a securities market investor. But among such a large number of investors, only 10% can profit consistently in the long run. Hence, there's a popular saying, 7 lose, 2 break even, 1 profit. Why do as many as 70% of investors lose money? Some say A shares underperform, not rising as steadily as U.S. stocks, especially the Shanghai Composite Index, which has hovered around 3,000 points for over a decade. However, over the past decade, the average annual return of the Social Security Fund has been about 8.3%, and over 50 years, that could mean a 53-fold return, showing A-shares returns aren't bad. Since A-shares can also yield long-term profits, the reason for losses lies with the investors themselves. The author of this book, in analyzing losing traders' accounts, found that loss-causing behaviors fall into 3 main categories. 1 is impulsive trading, like a gambler. 2 is blind trading without a plan. 3 is overtrading without a trading philosophy. This book explores methods to solve impulsive, blind, and overtrading. The author, Elder, was born in the former Soviet Union and later started his trading career in the U.S. Since he has a background in psychiatry, he pays special attention to investment psychology. After many failures, he found a path to successful investing. Compared to Buffett and Soros, Elder might seem less famous, but he's more suitable for ordinary investors because he starts, step by step, from avoiding loss traps, covering trading psychology, money management, technical analysis, trading systems, and trading practice. Next, I'll interpret it from these 5 aspects. Before starting trading, what loss traps do we need to avoid? First, avoid impulsive trading. Some investors agonize over saving a few cents at the market or whether online shopping offers free shipping. But in the stock market, they skip detailed research and analysis and never make a rational trading plan.
Seeing others profit, they get impulsive and throw tens or hundreds of thousands into investments. This is classic impulsive trading.
Second, reduce trading costs.
Investors have to pay trading costs, like commissions, stamp duty, and income tax, whenever they trade. These costs seem trivial.
A trade of 100,000 yuan typically costs around 20 yuan in commission. If you buy and sell once each day over 250 trading days, the commission adds up to 10,000 yuan. That's 10% of the account's principal. In 2021, revenue from securities transaction stamp duty plus broker commissions reached a staggering 350 billion yuan. And data from the China Securities Regulatory Commission shows that individual investors in A shares holding only 30% of shares contribute 70% of the trading volume. The person tells me, in other words, regardless of profit or loss, investors pay 245 billion yuan. That's why there's a saying, the lazier, the richer, because laziness avoids overtrading and cuts commission and stamp duty costs. Third, avoid slippage costs. Slippage refers to the difference between the price seen when placing an order and the final execution price. When investors place orders to buy or sell stocks, there are 2 basic execution choices, market or limit orders. Choosing between a market or limit order often determines whether you'll pay slippage losses. A market order is executed as fast as possible at the current price. It guarantees execution, but at the prevailing market rate. But due to market volatility, there's often a gap between the screen price and execution price. That's slippage. In contrast, a limit order sets the highest buy or lowest sell price you'll accept. This gives investors more control over trade prices, but it doesn't guarantee execution.
If the market price never hits the limit order's range, the order may not execute.
Slippage is everywhere in securities markets, but investors rarely notice. Driven by greed and fear of missing out, they rush to market orders and often pay more than the screen price.
So you've encountered slippage and want to know how much it'll cost you.
Just record the difference between the price you see when placing the order and the execution price, then multiply by the number of shares. For example, you buy one lot of stock at 22 yuan per share. That's 100 shares, but the screen price was 21 yuan per share. You pay a slippage of 1 yuan per share, so 100 yuan per lot. All. Similarly, you sell the same stock with a market order at 24 yuan, but the screen price was 25 yuan, so the slippage on the sale is 100 yuan. Because you used market orders, the total slippage loss is 200 yuan. But if you had used limit orders and were lucky enough to execute at 21 and 25 yuan respectively, your profit would be 400 yuan.
So, excluding transaction costs, slippage has eaten up half of your potential profit.
Therefore, we should proactively avoid these loss-causing traps. For impulsive trading, we can avoid it by making a trading plan, reducing position sizes, and cutting losses promptly. Second, while trading costs are unavoidable, we can reduce expenses by trading less frequently. For the third type, slippage costs, we should use limit orders instead of market orders whenever possible. Here you might ask, I also want to make a trading plan and hold stocks longer, but I just can't resist trading. What should I do? If I use a limit order to buy, how unfortunate it would be to miss a great opportunity. Yes, this is a problem that troubles most investors. In Elder's view, the root cause of being unable to hold stocks or fearing to miss opportunities is the lack of a solid trading psychology. And that leads us to the second part, how to develop a mature trading psychology.
According to the author, mature trading psychology means not being arrogant in victory nor discouraged in defeat.
You can't tell from a mature trader's face whether they made or lost money that day. To reach this state, investors must break 3 illusions, starting with the illusion of self-perception. The first is overconfidence. Many people often delude themselves into thinking that since they've succeeded in their current field, they can succeed in the stock market too. The second is gambler mentality. Gamblers often trade with heavy positions, leaving no buffer and refuse to accept failure. After a loss, they always want to recover immediately, ultimately causing even greater losses. Third is wishful thinking. Many cling to unrealistic hopes like overnight riches, turning thousands into millions in 10 years, or buying more when stocks fall despite mounting losses. Next, shadow the illusion that trading has secret formulas. The internet floods with trading tutorial videos, or so-called money-making secrets sold for a fee. These are all scams. Others obsess over automated trading systems, spending fortunes on trendy software, dreaming of effortless wealth while sitting idle, but it always ends in vain. Finally, abandon superstitions about trading gurus. Over 32 years, China's A-share market produced many enviably successful investors. Individual investors often copy their trades, but reality shows copying leads to more mistakes. Good stocks, theories, and traders exist, but nothing's absolute. Avoid so-called stock gods.
Trading legends act alone. Final decisions must be yours.
To avoid self-destruction, shatter these illusions by admitting limitations like an alcoholic admitting powerlessness. Losing traders resemble alcoholics. Some constantly change strategies. Others deny losing control.
Worst case, traders accelerate like sports cars into concrete walls until destroyed.
To regain control, admit weaknesses. Overtrading, heavy positions, emotional decisions, how to truly face oneself. According to Elder, this requires money management, market analysis, and building a personal trading system. And now to part 3,
Effective money management.
Money and position management mean allocating assets based on risk tolerance and market trends. Statistics show that 90% of performance gaps can be explained by money management. Heavy or all-in positions are classic examples of poor money management. Such behavior can easily destroy an account. Essentially, money management is risk management. So, how should investors manage their money? There are many money management methods. Elder uses the fixed fractional risk method, which is intuitive and easy. Just set a risk percentage. Older's fixed fractional risk has two rules: the 2% rule and the 6% rule, meaning no single trade should lose more than 2% of the account, and no month should lose more than 6%. Oh, he based this on the average person's risk tolerance. For example, in a 100,000 yuan account, the max loss per trade is 2,000 yuan. If losses exceed that, cut it immediately. The monthly max loss is 6,000 yuan. If monthly losses exceed 6,000 yuan, the investor must stop trading and restart next month. Remember, next month's max loss ratios are still 2% and 6%. But because last month lost 6,000 yuan, the 100,000 yuan account becomes 94,000 yuan, so monthly max losses adjust to 1,880 yuan and 5,640 yuan, respectively. So, how do you manage money under these monthly loss limits?
When investing 100,000 yuan in stocks, by Elder's standards, you can hold at most 3 stocks at once.
Because each stock's max loss is 2%, the account's total max loss is 6%, or 6,000 won. Even if you find a stock D that's highly worth buying, you can't buy it. Doing so would push total risk above 6%. After a few days, if stock A rises by 2,000 yuan, then you can buy stock D. Because stock A's rise eliminates its risk burden, lowering your total risk to 4%. If stock B hits its 2% stop loss, then no other stocks can be bought that month. Because stocks C and D already carry 4% risk, and stock B used up its 2% loss allowance. Position management is a dynamic process. Under the 6% and 2% risk control principles, you can adjust individual stock risks and overall risk allocation based on changes in your portfolio's market value, thereby modifying the position ratios of your stock funds. As long as you strictly follow money management strategies and control risks well, losses can turn into substantial profits. It can be said that money management is the foremost principle for surviving in the stock market. We build a firewall for our accounts through money management. So how exactly should we choose stocks and investment products that suit us? In other words, how can we analyze the market and select stocks through technical means? The main role of technical analysis is to accurately judge and precisely predict trends in the stock market and individual stocks, find the best times to buy and sell, and ultimately achieve the goal of enhancing investor returns.
First, let's understand the foundation of technical analysis: trends.
Although price fluctuations involve uncertainty, they have an overall direction. The reason trends form stems from the psychology of market participants. Generally, market participants can be divided into individual investors, commonly called retail investors, and institutional investors, which include public funds, private funds, insurance institutions, and foreign investors.
In A shares, this also includes Social Security funds, et cetera. But whether individual or institutional investors, they act as buyers based on their needs.
Sellers and watchers. Buyers buy when bullish on the market, sellers sell when bearish, and watchers wait for opportunities, ready to become buyers or sellers. When groups of participants decide to buy or sell, they reach a consensus on the value at a certain moment. This is the price. Generally, prices include opening price, high price, low price, and closing price. The opening price is formed by orders accumulated overnight and in the morning before the market opens. The closing price is determined by professionals trading throughout the day. The closing price represents the final outcome of the battle between buyers and sellers that day. And if the closing price is near the day's high, that indicates that buyers dominate. If the closing price is near the day's low, it shows that sellers dominate. So what is the relationship between crowd psychology and market trends? First, price is the leader of market trends. If investors believe a stock will rise, they'll continuously buy shares. As market demand for the stock increases, its price also rises. If investors believe their stock has a downward trend, they'll sell. When group demand for stocks decreases, prices fall. This explains stock fluctuations. Therefore, understanding market participants' psychology helps observe price trends, key to successful investing. Since crowd psychology drives price formation, support and resistance levels emerge as bottoms and tops. Support is where bullish strength holds decline. Resistance is where bearish pressure counters rallies.
The effectiveness of support or resistance depends on its duration, height, and trading volume.
Generally, longer duration, greater height, and higher volume strengthen support or resistance zones.
Knowing support or resistance is crucial for traders.
First, protective stop losses.
Limit orders are often set based on support levels.
If a stock has strong support at 20 yuan, set a stop loss limit order at 20 yuan.
Once price falls below 20 yuan, the stop loss triggers, protecting your account.
Second, support or resistance signals trading opportunities. If the 20 yuan support is strong, a dip to that price often presents the best buying opportunity. Similarly, if 50 yuan resistance holds, take profits there to secure gains. Individual behavior is hard to predict, but group behavior is simpler to track. Thus, traders analyze markets through crowd psychology. The best indicator? New highs minus lows index. Stocks hitting yearly highs minus those at yearly lows.
Why use this to gauge markets?
As mentioned earlier, when investors favor a stock, continuous buying drives its price higher. Similarly, when investors abandon a stock, they keep selling, driving its price lower. In other words, the new highs-lows index tracks the strongest and weakest stocks, comparing their quantities to identify market trends through leading gainers and losers. This explains why trading focuses on leading stocks. Since A shares currently only allow long positions, we monitor the new highs-lower index. The index helps determine if the overall market trend is upward. If yes, we buy. If downward, the best strategy is to clear positions or stay inactive. Never trade against the trend. Once we confirm an upward market trend, we can select individual stocks. First, consider liquidity. Stocks that are easy to buy or sell with minimal slippage. Liquid stocks protect your account. During market crashes, small-cap stocks often have poor liquidity, making stop losses impossible to execute even if set. But liquid stocks rarely face sellability issues. This prevents massive losses from being unable to sell. Second, consider volatility, a stock's short-term movement range. Higher volatility means more trading opportunities. Popular stocks often swing wildly.
The most common volatility measure is beta, the ratio of individual stock volatility to market index volatility, available in trading software.
If an A-share stock has beta equals 2, when the Shanghai index rises 1%, the stock rises 2%.
Similarly, a 1% index drop means a 2% stock drop.
Higher beta stocks have greater volatility and risk. Finally, wait for clear signals from one or more technical indicators. Technical indicators, derived from open, high, low close prices and volume, are tools for trend judgment. This book categorizes them into trend following, oscillators, and others, all based on those 5 data points. For example, moving averages are determined by a single closing price, while accumulation and distribution indicators require all 5 data points. So how do we choose technical indicators?
The author believes we should combine different types of indicators to avoid errors from relying on a single indicator for trend determination.
Though many view technical indicators as illusory or lagging, the author argues they fundamentally represent investors' social psychology. Through technical indicators, investors can understand price-time relationships and gain competitive advantages. 8. Moreover, technical indicators are vital to trading systems. Without them, building effective systems for market analysis and stock selection is impossible. Now, let's examine how to build a trading system. A trading system is a complete set of rules for finding opportunities, timing trades, and controlling position sizes. A trading system includes at least 5 components. First, what to buy, asset allocation, or stock selection. Second, how much to buy, money management and position control. Third, when to buy. Fourth, when to sell. Fifth, when to cut losses, risk management. This rule protects your account. Generally, trading systems fall into 2 categories: discretionary systems with high decision freedom and mechanical systems. Discretionary systems rely on investor judgment, offering autonomy for experienced traders. Mechanical systems follow strict, customized operations. Today's quantitative trading systems are typically mechanical. For example, the fixed fractional risk method executes trades based on preset technical parameters. For novice or undisciplined traders, mechanical systems prevent impulsive trading. Many lose on their first trade, refuse to accept it, buy more as prices fall, amplifying losses until trapped.
Like PetroChina at 48 yuan in 2008, now worth only 5.2 yuan, a near 90% plunge.
But following the 2% rule and cutting losses promptly keeps losses minimal. This book details the triple screen trading system, a mechanical approach based on selected technical indicators. This is Elder's greatest contribution and one of the most important aspects of this book. The core of the triple screen trading system is that the larger time frame determines the smaller time frame. The smaller time frame influences the larger time frame. When the larger time frame is rising, you can hold stocks confidently and even add to your position.
When the larger time frame is falling, you absolutely must not hold stocks. Instead, you should sell.
The so-called larger and smaller time frames are relative. If the larger time frame is yearly, then the smaller time frame is monthly or weekly. If the larger time frame is daily, then the smaller time frame is hourly or 15-minute. According to the author's definition, the triple screen is based on trading with weekly charts, which can also be called the medium-term time frame or medium-term trend. In other words, the commonly used 3 time frames are weekly, daily, and 60-minute. For every potential trade, it must pass 3 tests or filters. If it passes all 3, the chance of success is high, but many trades that look good at first glance get rejected by 1 filter, indicating risk. For the first screen, the author uses the most common trend-following indicator, the MACD indicator found on trading software, to judge the long-term trend. MACD stands for Moving Average Convergence Divergence. The moving average is calculated by subtracting the slow exponential moving average from the fast exponential moving average to get the diff line. Then, calculate the 9-day average of the diff to get the DEA. Subtract DEA from DIF and multiply by 2 to get the MACD histogram. Technically, when DIF is greater than DEA and both are rising, the MACD histogram value can be below the 0 line, but it must be in an upward state. This indicates that the bulls are dominant and it's time to buy or hold stocks. The second screen uses the daily chart to determine trends. In an uptrend on the weekly chart, look for buying opportunities during downtrends on the daily chart. Here, the author uses his self-invented indicator called the force index, which is today's close minus yesterday's close multiplied by today's volume. The larger the price difference in volume, the stronger the upward or downward force. The third screen is to determine specific entry and exit points. If the weekly chart trend is upward, then when today's force index is rising, watch. When it's falling, buy. Conversely, if the weekly chart is downward, then sell when the force index is rising and watch when it's falling. Once you buy, If the market moves in your favor, quickly adjust your stop loss to protect profits.
If a trade doesn't profit immediately, it signals underlying changes. Exit fast.
The first chance to cut losses is often the wisest and cheapest exit. When using this system, trade small positions, choose liquid blue chips. The triple screen system excels at identifying medium-term trends. Most individual investors follow mid-term trends, making this system practical. Remember, hold or add when larger time frame rises. Sell when it falls. Daily MACD signals holdings. When it turns bearish, especially DEA crossing below DIF, sell to protect gains. If weekly MACD breaks down DAA below DIF, sell decisively, liquidate if declines continue.
DEA crossing below DIF plus MACD below zero equals strongest bear market signals.
When weekly charts bottom out, DEA crossing above DIF, expect midterm reversals. We've covered psychology, money management, analysis, and systems, unified through trading journals.
A common reason for failure: not keeping trading records.
Good journals prevent impulsive trades and repeat failures. Replicating successful trades creates account miracles. The author's journal advice targets professional investors. Use custom daily logs. Record major news, currency or commodity movements, key indicators to prepare. Before daily trading, self-assess mental state, emotions, schedule to evaluate readiness.
After completing the psychological test, you also need to rate today's trading plan.
When a trade signal appears, evaluate point by point if it meets your standards, and finally decide whether to execute the plan. Generally, trading records include two parts. First, after each trade, record the buy or sell prices, quantities, reasons, holding period, profit or loss amount, trade count, position size, and so on. The best way is to print out the candlestick charts, mark your entry and exit points, and use them to review, ponder, and analyze your trades, summarizing successes and avoiding failures. Second, always monitor changes in your account's equity curve. Only an upward curve proves you're using a successful trading system or executing a solid plan. That's, if the equity curve is declining, it means problems with money management, trading system, or psychology. Find and fix them right away. If you can diligently analyze trades, faithfully keep notes, and regularly summarize your findings, then you already know why you lose money and how to make it. This means you're ahead of 90% of folks aiming for steady profits. The best approach is to repeat your winning trades and dodge your losing ones. Finally, let's recap this book. For investors, the first thing isn't how to make money, but how to lose less. Preserve capital so you can eventually earn. To preserve capital, first we must nail money management. Whether you've got 100 million yuan or 10,000 yuan in the market, money management is crucial. It's firewall for your account. Second, to make money, we gotta build an effective trading system and stick to it strictly. Lastly, always keep trading records, learn from mistakes, and gradually sharpen your skills. Remember, if you mess up, calmly accept it, learn the lesson, and keep moving forward. As long as you avoid pitfalls and minimize errors, persevering long-term, you'll be a successful investor. All right, that wraps up our intro to elders trading for a living. Book notes are below the audio. See you next time.